Hey, this is Ty Miller with the Portfolio Strategies team here at Five Plan Partners. Hope you're doing well today, and thank you for joining us for another educational insight. Today's focus is going to be on markets and midterms. So today I'll be discussing midterm election years and how they impact the market specifically. 2026 is, of course, a midterm election year. And while this vlog won't be making a prediction on who wins what, it will look back at what history normally tells us happens with the markets in this unique year. As you can see in this chart, midterm years often lag behind other years when it comes to market performance. In fact, the midterm year is the only year with negative quarterly price return for the market, and it happens in quarter one, quarter two, and quarter three. Now, this doesn't have to be the case this year, but one of our favorite sayings in the office is that history doesn't repeat itself, but it often rhymes. And so far, it is rhyming. As you can see in this chart, the blue line is the historical average S&P return over a four-year presidential cycle, and this dates back to 1961. The red dotted line is where we currently are, so pretty close to on trend. Luckily, if we look out to years 3 and 4 of a presidential term, those are years we would like this trend to hold. As you can see, they're very positive. The funny thing about election year is that GDP growth is often the strongest of any year in a presidential cycle. As you can see in these charts, which date back from 1994 to 2025, that outsized GDP growth doesn't necessarily equal outsized market performance, as you can see in the current midterm year. We, of course, know that markets can always be volatile. This chart really shows how much more volatility you see in midterm years than other years, even a presidential election year. The average drawdown for the market in a midterm year is nearly 20%. However, the red bar shows the performance 1 year after the correction, and you can clearly see the outsized return profile. Lastly, this chart shows the period 12 months after the midterm election has taken place. The market has not been lower 12 months after a midterm election since 1938. So if history tells us anything, it's that this volatility should be temporary. I hope this helps break down the history of midterm election years and market performance. Please keep in mind that past results do not equal future returns. And as always, please reach out with any questions or if you'd like to continue the discussion. Thanks.